They're not cooling off. They are in free fall. As I'm recording this, gold has just broken 4,600. Silver is at 72. And every time I refresh my screen, it's lower. 4550, 4520. This is not stopping. This is no longer a correction. This is a crash in real time while you're watching this video. Friday was supposed to be the worst of it. Silver down 38%, gold down 16%. The worst single day in 45 years. Everyone thought that was the bottom. Everyone thought the selling was done. Everyone was wrong. What you're watching now is pure liquidation, forced selling, margin calls cascading through the system, accounts getting wiped out one by one. And here's the key part. It's accelerating, not slowing. Welcome to the hidden economy. If you're new here, this channel exists to explain what's actually happening in markets while everyone else chases headlines. Subscribe because you will not hear this analysis anywhere else. Now listen carefully. If you watched my last video, you already know why 117 was the critical level for silver. I explained exactly why a crash from there was likely. At the time, people laughed. Look, it's going to 118, 120. And then this happened. Now let me tell you something most people still don't know. This morning, when markets opened, thousands of traders tried to sell their silver ETFs. Orders rejected, circuit breach. Friday's crash was so violent that today's prices are still below circuit limits. The exchange literally will not accept sell orders. People who held through the weekend hoping to exit Monday morning are trapped. They cannot sell at any price. Gold breaking 4500, silver crashing through 72, and the system won't let them out. Here's why. The weapon is called a margin hike. When you trade futures, you don't pay full price. You post margin, usually around 10%. Control $100,000 of silver, you post 10,000. That's fine, until the exchange raises margins. And when they do, you don't get a grace period. You don't get a warning. You need cash immediately. If you don't have it, your position is liquidated automatically at whatever price exists in that moment. And when everyone is forced to sell at the same time, the price is always the worst possible one. One margin hike is survivable. Two is painful. But what if there are 8 margin hikes in 8 weeks? That's not risk management. That's extermination. That is exactly what the CME did. December and January, hike after hike, Christmas Day, New Year's weekend, no breathing room. Then January 13th. CME switched to percentage-based margins. Now, when silver rises, your margin requirement rises automatically. A tightening trap. The higher price goes, the more cash you need, even if you do nothing. And after Friday's massacre, another hike Monday morning, then another one this week. 8 hikes total. For context, 2024 had 2, 2023 had 3, 2022 had 2. 7 hikes in 3 years used to be normal. 8 hikes in 8 weeks has never happened before. I checked 20 years of CME data. Unprecedented. Each hike forces selling. Forced selling drops price. Lower price triggers more margin calls. That's the death spiral you're watching right now. Gold 4500, silver 72, and falling. Now here's the part that should really bother you. The same day CME raised margins, the Shanghai Gold Exchange raised margins from 20% to 26%. Same day, same direction. Chicago and Shanghai, 14 time zones apart. These two agree on nothing. Trade wars, sanctions, geopolitics. But on silver margins, perfect lockstep. That only happens when they're scared of the same thing. And here's what they're scared of. 356 to 1. That's the paper to physical ratio on COMEX. For every 1 ounce of real silver, there are 356 paper claims. That works until people demand delivery. And they are. In the 3rd week of January, 33 million ounces of silver walked out of COMEX vaults. Not traded. Physically removed. That's 26% of inventory are gone in 1 week. 4 years ago, COMEX held 430 million ounces. Today, 113 million, 74% gone, and accelerating. March is why this matters. March futures represent 528 million ounces of promised delivery. Vaults hold 113 million. They've promised almost 5 times more silver than exists. First notice day is March 27th. If just 22% of contract holders demand delivery, the vault is empty, not stressed, empty. This is the nightmare scenario. That's why margins are being hiked. That's why longs are being shaken out. And here's the smoking gun. Look at the prices. COMEX silver, the paper price, $72. Shanghai silver, physical delivery, $100. Same metal, same day, same planet. A $28 gap. That's a 39% premium for physical. If silver were really worth 72, no one would pay 100. But sophisticated buyers are. And the gap isn't closing. Friday, $25. Monday, $30. Today, still 28. Paper collapses. Physical holds. That tells you everything. Now ask yourself, who benefits? JP Morgan, largest silver short in history. Bank of America, HSBC. Every dollar silver drops, they make hundreds of millions. These banks sit on exchange committees. They know positioning. They know pressure points. Retail lost 38% Friday. Banks made billions. Draw your own conclusions. Add to that, a false Reuters story Thursday night. Algorithms triggered selling. 3 hours later, the government said the story was false. Too late. Then a Fed chair leak, then margin hikes. Same window. And the day before the crash, unusual options activity. Massive put buying. Someone knew. Now look at the damage. China. UBS SDIC Silver Fund halted. Entire session. No trades. US. ProShares Ultra Silver down 62% in one day. iShares Silver Trust down 31%. Worst day ever. Traders couldn't sell. Orders rejected. Platforms frozen. Phone lines jammed. Crash the price. Lock the exits. Raise margins again. That's the sequence. Now the fundamentals, and this is the insanity. 5 straight years of silver deficits. Exploding demand. Flat mine supply. Cumulative shortfall since 2019, 1.3 billion ounces. Then China restricts exports January 1st, 2026. Silver added to strategic materials list. Export volumes down 40%. China refines 65% of global silver. And the price crashes? That only makes sense if paper is being crushed ahead of March delivery. Physical always wins. But first, damage. Here's what I'm watching. The Shanghai Premium, currently $28. COMEX vault levels, reported weekly. Lease rates, 8 to 10%. Normal is 0.5%. March open interest. Trading halts and platform freezes. These are the warning lights. This is not random. This is not normal. This is not profit taking. 8 margin hikes. Coordinated exchanges. Vaults draining. Paper collapsing. Physical holding. Paper can be printed. Metal cannot. That truth has held for 5,000 years. Crashes don't destroy wealth. They transfer it. The only question is, which side are you on when paper finally reconciles with reality? Subscribe. I'm covering this daily until it breaks.